It seems like it's no longer a case of if the Fed is going to be cutting interest rates. It's a matter of when, and quite frankly, how many times. That's what Fed Chair Jerome Powell recently told CBS's 60 Minutes.
We have a strong economy. Growth is going on at a solid pace. The labor market is strong, 3.7% unemployment. With the economy strong like that, we feel like we can approach the question of when to begin to reduce interest rates carefully. We want to see more evidence that inflation is moving sustainably down to 2%. We have some confidence in that. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut interest rates.
Remember in 21 when he said that inflation was transitory? Anyway, Powell says look for cuts to begin closer to the middle of this year. What should investors consider doing in the meantime before those rates come down?
Yeah, kind of like the perfect storm, I think, to be taking a look at where we're at in today's environment and how interest rate cuts could impact people's retirement plans. When we look at it, I would say number one is you want to review your current portfolio allocation. What we have here is we have stocks at record high. Historically speaking, when interest rates come down, there are certain stocks that tend to benefit from lower interest rates, right? That could use the borrowing power with lower rates that are out there. So it's very important, I'd say, to know what you own inside of your investments, especially with the market at record level highs. On the flip end of the scale, you've got fixed income interest rates are at record level highs as well. In fact, some of the products that I've seen out there on fixed rates have been the highest in 20 years. So what you kind of want to do is maybe number two is consider reviewing the duration of your fixed income investments. There's literally something called the cost of liquidity, and a lot of people like to have their money liquid. And I think it's important, as you talked about earlier in the segment about emergency funds, maybe money you're going to need over the next 3 to 5 years. You want to have plenty of liquidity there. But for the longer term money, why not put it in a product that you can lock in decade level interest rate highs for as long as you possibly can?
Sure.
And, if it's something that you're not going to need for a little while, you want to review that duration of your fixed income investments. Consider locking in rates for a longer period of time. Number three, the tip I'll give here is, interest rates are sensitive. So, again, when rates go down, bond prices historically go up. Again, looking at the asset allocation of the portfolio, if rates do come down, it could make the fixed income bond market even more attractive after taking a couple of brutal years of getting beaten up with rates going up. So 3 good tips on, what I would say with how to position your retirement plan when interest rates come in. Anything that you're saying, Chaz, to clients about outlooks and the impact that it could have?
I think it's positive. Lower interest rates for the most part. I know for savers, it was a positive that they could kind of hide out in some of these short duration money market, safer instruments. But I think as those interest rates come down, as you point out, it's going to give an opportunity for maybe some of the money that's on the sidelines to start to enter back into the market. So there may already be some kind of pent-up demand for stock, just kind of waiting for the interest rates to come down so that they don't have a choice. And we saw that kind of the better part of the last decade where there was no measurable interest to speak of, so people kind of were forced into stocks, and that kind of pushed the market up. And that may have been an impetus for the return, the great returns that we've had. The other thing that I'll say generally is that we've kind of all have our eyes on the housing market right now with interest rates as high as they are. So I think that may offer an opportunity to kind of pivot into some of the sectors of the economy that haven't participated as heavily in the growth. It's been led by the Magnificent Seven or the FANG stocks or whatever acronym you want to refer to these behemoth stocks. But the reality is the market as a whole hasn't enjoyed a whole lot of participation, housing being one of them. So that might be an area where you could maybe speculate a bit with some funds if you expect interest rates to drop.
Guys, don't you think it's still an opportunity, though, right now for some of that lazy assets that you've got sitting in there earning next to nothing right now to still move that money into something that's still going to earn you a little bit more rate of return there? One of the things that I tell all my clients is, the health savings accounts. I mean, a lot of these health savings accounts were earning next to nothing, and now you have an opportunity to at least ride this wave, so to speak, of high interest rates. Get that money out there and let it work for you, because that's only going to increase your your balance in those accounts that you can use for your medical benefits. But I mean, it's still an opportunity, right?
It is.
To invest in some money markets that are going to get you some higher yields.
Yeah, it's still a great opportunity to put lazy assets to work. And at the end of the day, really what it comes down to is what I call portfolio optimization. It's making sure that if you're not going to get up and go to work tomorrow, that your dollars get up and go to work as hard as possible. And the neat thing is with some of the technology that's available, like the tools and research that we use in our investment policy statements, we're able to really take a look at putting that all together to try to get you a portfolio that is optimized, making sure that every dollar is working as hard as possible. So again, if you need to find out, is there a way that you can make your money work a little bit harder? Give our office a call. We'll be happy to put together an independent portfolio analysis for you.
We've spoken many times here on the show against the notion that you can time the market. It's nigh impossible, especially consistently. But this is one of those situations when it comes to these interest rates, they are not just guessing that they're going to come down at some point in the future. They're saying as much. So this is a really good opportunity to see how you can make this work in your favor. The team at America's Retirement Headquarters, they can help explore those options and show you how to make your money work a little harder. 419-794-3030. That's how you schedule a time. You can also go online to the website as well, and that is arhq.com.